Good morning, good afternoon, and welcome to RCLCO's monthly webinar. This month, we will discuss the current state of the housing market and the 2021 STEM Job Growth Index rankings. Thank you to everyone who is joining us live here today or who is downloading the webinar from the RCLCO website. As an introduction, I am Kelly Mangold, a principal here at RCLCO, and I'll be moderating the webinar today. If we could flip to the next slide, I'll be joined by my colleagues, Gregg Logan, Managing Director, and Karl Pischke, Vice President, as well as a special guest, Dan Terpening from CapRidge Partners. We've been doing this webinar series for about a year and a half now. We could advance the next slide. And I realized that while most of our audience is well acquainted with RCLCO, that there may be some listening who are not aware of our company's background. RCLCO Real Estate Consulting is celebrating our 54th birthday this year, and our company has evolved over the years to serve a diverse array of clients, performing work across the nation as well as internationally. Our company has three major practice areas, including the Real Estate Economics Practice Group, which is the group that Gregg and Karl work within. They perform market analysis and other strategic consulting work for developers, large landowners, public sector, and other client types, working out of our Orlando, Florida office. Next slide, please. Our special guest, Dan, is joining us from CapRidge Partners, which is a fully integrated operating company investing in value-add real estate growth markets. They follow a rigorous management process and are rooted in customer service. Next slide, please. Dan is a managing director at CapRidge Partners and oversees acquisition and asset management for the firm. Dan, welcome. It's good to have you with us.
Thank you, Kelly. Happy to be here.
Great. If we move on to our agenda, today we'll be covering two topics. The first will be Gregg's residential market update, where he will provide some color commentary on the trends we have been seeing in the housing market and insights to what housing developers and investors are saying about the current economic conditions at play in the market. Then, Gregg and Karl will be joined by Dan Terpening of CapRidge to discuss the latest results of our collaborative research project, the 2021 STEMdex. They will explore the list published earlier this week on the top STEM markets and what this may mean for the real estate industry as we wrap up 2021 and head into a new year. We'll get into our discussion in a minute, but as a reminder, these webinars are designed to be interactive and engaging. If you have any questions throughout the process, please feel free to submit them into the chat box. We'll do our best to address them as we go along. However, since we have several presentations today, we may leave some of the questions to the end just to make sure we can get through all of our planned content. As I mentioned briefly, this webinar is being recorded. It'll be available on the RCLCO website shortly after we end. Be sure to check out all the other research and presentations we've been publishing at rclco.com. There you'll find lots of content, including access to the presentation from today. I will now turn this over to Gregg to kick us off with the residential market update. Gregg?
Thanks, Kelly. So I'm going to jump right in here and we'll also show how the residential market update and some of the things that we're tracking also dovetail really well with what we're seeing and what our forecast model is saying about where science, technology, engineering, and math jobs are going. Real quickly, you're looking at just the home builder sentiment index. You can see we were down a little bit over the summer, and that was sort of corresponding with dealing with the Delta variant. And now that things seem to be improving somewhat, you can see that in September and October, that index popped up, still at very high levels. There are indicators on the housing side, of course, that show some near-term softening in the market, at least relative to 2020. But overall, home builders remain optimistic. We're looking at the construction side. We've all heard and read a lot about what's happening with supply conditions, and unfortunately, that's still with us and probably still be with us into mid 2022. And those supply issues have been holding back construction somewhat. So you see a decline in permits in September and starts and completions from the previous month, below August and below where we were in 2020. And we're interested in that because permits are somewhat of a leading indicator. If we look at where completions are or where starts are, permits give us kind of the best indication of where things are going. And the fact that they're down suggests that we still have some issues to resolve. In terms of looking at where home sales are going, so the lighter gray bars show last year, 2020. The darker gray bars show the current year. Overall, sales are down. You can see on the blue line the year-over-year change, which really peaked last April, where we were sort of humming along at a faster pace than 2020. That fell off over the summer, and the month-to-month change, reflected that. We are seeing a little bit of an uptick in the month-to-month change. This is new single-family home sales, I should say. Overall, supply is up a little bit, but still at very moderate levels, and some indication that things may pick up as we deal with some of the supply chain issues. This shows activity across the country, and what we're showing here in terms of where the sales are strongest in the south and the yellow bar there, and followed by the west. And we also overlaid what we're going to be talking about in a few minutes when we get into the STEMdex, where we see the greatest potential for growth in STEM employment. And what's interesting is it dovetails pretty well with also where we see the housing activity. So if you look at the south areas of the country, the south region there, you see actually the most market areas, followed by the western US, with some of the top areas as well in the west, and then not a whole lot in the west, in the Midwest, west, north central, and east central, and then in the North Atlantic and the east. And that dovetails pretty well with also where we're seeing housing activity. So it does seem to be somewhat predictive in where real estate activity, even on the residential side, is happening. One of the things we're all also keeping an eye on, as I'm sure you are, is what's happening with home prices and where home prices are going. And I think most economists agree that the kinds of home price gains that we've seen over the last 18 months are really not sustainable. $452,000 average new home price in September, way up over September 2020, is making affordability continue to be a challenge. And that's something that we've been saved a little bit by the fact that we still have historically low interest rates, but we're very vulnerable to interest rates rising, and the interest rates rising with these really high prices, can take some of the steam out of the market. I think we're sort of seeing that we've gotten through really elevated housing demand as a result of the pandemic in 2020, and we seem to be moderating off of that and getting back to just sort of normal strong demand. And interest rates and prices obviously are governors of where that could go. Just looking at where interest rates are going, again, still historically low. For those of us who remember that we actually still had a housing market when we had interest rates in the teens. So we're still historically low, but we are looking at rates ticking up a little bit. And as the economy continues to improve, and the Fed is looking at the market and saying, do we really need to keep propping up the market the way that we are? And we'll see some news on that from the Fed next week, actually. That kind of suggests that we may see some ticking up in interest rates, at least through the rest of the year. Not dramatically so, but enough that we need to keep our eye on it and its impact on the housing market. Who's out there buying is interesting. It's very interesting to me as part of the baby boom generation, that if you look at who's actually buying houses, people over 55 are still a third of the market, and really exceeding by a very small amount, but the third of the market that really is that younger millennial and some of the younger Gen Ys that are in the market and buying, and then Gen Xers making up the balance of that. And that's obviously bodes very well for all kinds of senior housing, active adult communities, which are going gangbusters and so on. One of the other things that's really helped us to keep strength in the new home market has been that the existing home market's been very tight. So, very, very low inventory of existing homes, low interest rates, all that has been very good for the new home market. And it seemed to level off a little bit over the summer and even fall and in September in terms of where inventory is, and not great for the existing home market or great for where prices are going to go, but it does certainly provide some strong underpinning for the new home market. This is just looking at where existing home sales are. You can see how like the new home sales that fell off over the summer with the rise of Delta and people sheltering in place a bit more, and how getting into September that's starting to pick up again, not back up to where we were pre-summer, but ticking up in a positive way. Then thinking about Where does that go longer term? This is actually Fannie Mae's most recent forecast numbers. You can see where we're sort of falling off in second and third quarter of 2021. Their read is that things will continue to pick up in the last quarter of the year, and are bullish on as particularly as we get through some of the supply chain issues and into mid 2022, that we'll be back to a pace similar to what we saw in mid to late 2020. So with that, I'll conclude the housing market update and throw it back to Kelly, who will kick us off on the STEMdex. Kelly.
Thank you. I actually think Karl will be taking this part. Karl, take it away.
Thanks, Kelly. Thanks, Gregg. I'm very excited to share the results of our 5th annual STEM Job Growth Index, or the STEMdex as we refer to it, which has really become a big initiative for us at RCLCO and our partners at CapRidge. STEM, of course, stands for science, technology, engineering, and mathematics. And the purpose of the STEMdex is really to highlight the cities and metropolitan areas that we feel are poised to see significant future growth within their STEM industries. We started this process 5 years ago because we felt that STEM jobs represented an important industry for us to track, just given how critical of a role that STEM jobs have begun to play in our lives, and also because of the positive implications that STEM employment has on a local economy. So on that first point about the importance of STEM in our lives, we sit here today nearly 2 years into a global health crisis and pandemic. And so it's not hard to look around and see how jobs in science are impacting our daily lives, whether that has to do with making public health policy or manufacturing vaccines, or even creating the technology that's allowed us, or many of us, to work virtually or remotely, such as through this platform that we're using today on our webinar. But of course, even before the pandemic, STEM industry had grown at a rapid pace, much ahead of non-STEM jobs. So between 2005 and 2015, for instance, STEM employment grew by nearly 25%, and that is over 5 times more than non-STEM jobs during that same period. Over the course of the 2020s, the US Bureau of Labor Statistics projects that more than 1 million STEM jobs will be added, and that represents nearly 11% growth compared to an average of about 8% in other industries. With regard to the second point I made earlier about the positive implications that STEM employment has on a local economy, it's important to note that the average STEM job in the United States has a wage of nearly $90,000, and that's compared to an average wage of about $40,000 for other industries. And in addition to that, our research has also indicated that STEM jobs tend to be more resistant to economic shocks. And so as an example of that, the unemployment rate for STEM roles in 2020 peaked at about 9%, compared to about 16% for non-STEM jobs. So obviously a very important factor. Furthermore, the STEM industry is represented by a fairly diverse range of labor, as we're showing on the graph on the screen. About 47% of STEM jobs are focused explicitly on computer-related professions. That's actually projected to grow to 49% by 2029. And that includes jobs such as computer and information systems management, programmers, software developers, and other computer support specialists. Mathematics, engineering, life and physical sciences, and social sciences really comprise the remaining half of STEM jobs. But it's important to note that the fastest growth that we've seen, particularly in recent years, has been in computers and mathematics related professions, and that's likely to remain the case for the foreseeable future. However, the projections made by the Bureau of Labor Statistics on the likely growth of specific jobs within the STEM field over the next 10 years or so has been somewhat impacted by the COVID-19 pandemic. Life, physical, and social science jobs, for instance, saw a more significant bump in those revisions compared to previous expected job growth. That category includes jobs like medical scientists and epidemiologists, which are obviously 2 professions which have received a lot of well-earned attention in light of their impacts during the COVID-19 pandemic. And so it will be interesting to see how those projections continue to be revised as we continue to recover from the pandemic. If we can go to the next slide, please. Before we get into the official rankings of this year's STEMdex, I'd like to first take a minute to talk about where STEM jobs are located today and discuss what is and isn't implied by the actual STEMdex rankings. So first of all, to talk about where STEM jobs are located today, we like to use a location quotient analysis. And that's a comparison of the concentration of jobs in a particular industry compared to the US overall. A location quotient greater than 1, for instance, indicates that a particular industry is more prevalent in a metropolitan area than in the US overall, while a concentration below 1 indicates less prevalence. So for a specific example, San Jose, California, really the heart of the STEM industry with Silicon Valley, has the highest location quotient for STEM employment at 3.25. So that means that the percentage of total employment that is made up by STEM jobs within San Jose is 3.25 times higher than the percentage of total employment made up by STEM jobs in the US overall. Now, the reason we like to use this location quotient analysis to describe where those jobs are today is because it helps put all MSAs on a somewhat even playing field. If we were to look, for instance, just at the absolute number of STEM jobs, or any jobs for that matter, the top 10 metros in that analysis would correspond roughly similarly to the largest 10 metros in the US. Now, having a high location quotient and having STEM jobs represent a significant portion of your local economy is obviously a strong indicator that you may be poised for future growth within that industry. RCLCO research into the growth of job corps has shown that industries tend to cluster within areas where similar industries or companies already exist, because they're able to gain efficiencies due to the location of supplies and materials, as well as access to a talented employment pool already trained for work in that industry. However, the STEMdex is really meant to be a forward-looking projection of cities poised to capture future growth. And so it does not just rely on an understanding of where jobs are today. And so as you can see in the rankings here, that the rankings by location quotient do not necessarily line up with the rankings in the STEMdex, which you see on the far left and far right of the graph on this slide, respectively. Though you do see many of the cities that do make it into this year's high rankings of the STEMdex do tend to have somewhat strong location quotient scores. But if we can move on to the next slide, please. As I had mentioned before, there are many other factors that go into our analysis for the STEM Job Growth Index, and that ranges from specific STEM performance metrics to overall economic growth factors, workforce quality data points, quality of life metrics, and business climate considerations. Over the past 5 years of our conducting this analysis, we've really been able to run a lot of very interesting correlation analyses on these factors against the cities which have actually seen the most significant STEM growth, or otherwise have high existing concentrations of STEM jobs, in order to calibrate our analysis with the weightings of factors that are actually based on historical performance. So this, of course, impacts our rankings from year to year, but results in a more accurate and trustworthy analysis. I'll also note briefly, before we turn to the results of this year's STEMdex on the next slide, that the health of a city or metropolitan area's economy is based on many more factors than those which we've identified here as directly impacting or correlating with STEM growth. So in the real estate industry in particular, we believe that tracking these factors and understanding the momentum and growth of STEM jobs is important because it can indicate where opportunities exist for future investment and for future growth, both for commercial real estate directly related to these jobs, as well as residential real estate, as Gregg pointed out in the earlier slide, in these cities that are trying to find ways to house these new workers. However, there are many other factors that also impact the health of a city's real estate industry. And later in this presentation, we'll unpack that a bit more as we think about how the STEMdex should and should not be viewed to evaluate a city's potential from a real estate perspective, especially as we start looking at some of the specific cities within the STEMdex. So if we move to the next slide, without further ado, I'm happy to share the current 2021 STEMdex rankings. At the top of the list this year are 3 cities which have consistently performed very well and ranked highly in many of our STEMdex forecasts over the past 5 years. Those are Denver, Seattle, and Austin. I will note, however, that there are about 384 or so metropolitan statistical areas in the United States, and our analysis really focusing on the 50 largest. So securing a spot within the top 20 of this list is a very significant achievement. I'll turn it over in a few minutes to Dan to talk a little bit more about what he and CapRidge have been seeing and some of the top cities on this list specifically. But first, I'd like to call attention to a few of the bigger movers on this year's STEMdex, including, to start off, Washington, D.C. and Boston. Both of these cities represent current strongholds for STEM employment. They rank 5th and 8th respectively on the STEMdex, but they also come in within the top 10 of the highest location quotient scores among MSAs. Both of these cities were also in the top 10 in terms of recent absolute and percentage growth of STEM jobs over the past 5 years, which indicates that not only are these cities where STEM jobs currently represent a major component of their economies, but they're also places where STEM jobs are growing at a much faster rate than many other metropolitan areas in the rest of the country. And of course, both of these cities recently made headlines, particularly with Amazon, after plans were announced to hire an additional almost 2,000 workers at their HQ2 site in Arlington, and then in Boston to add more than 3,000 new jobs to the company's tech hub. Another big mover on the list this year, which I'll also mention, is Minneapolis. Minneapolis also represents a stronghold of STEM employment, with the concentration of STEM jobs within that MSA 1.35 times higher than the US overall. A recent headline for Minneapolis actually was an announcement that Accenture would add over 1,000 apprentices to a tech apprenticeship network to provide opportunities in tech to underprivileged youths, as one example of some recent movement within the STEM industry, which really is just representative of the many things that these cities are doing well that has allowed them to, put them in a position for capturing future STEM growth. Before we talk a little bit more about some of these cities specifically, and also turn it over to Dan to talk a little bit about what he is seeing at CapRidge in relation to some of the recent performances there, I'd like to turn it over to Gregg real quick to talk a little bit about the COVID-19 pandemic and how we might view the potential future growth within some of these cities through the lens of what we've seen historically in other pandemic examples.
Sure, Karl, thanks. The short answer is we don't really know. We have seen some current evidence, and there has been a number of articles and analyses done by different economists on how different areas of the country are doing relative to the COVID pandemic, how well or not well they've implemented public health interventions and so on, and that has related to their overall economic performance. There's also some past data on looking at past pandemics. MIT economist Emil Vermeer wrote a piece that was widely circulated on how areas that implemented more robust public health interventions had better overall recoveries, and so we thought we'd be remiss to ignore that. And so we have our list of places that may improve, because we're looking at vaccination rates and other health metrics as a proxy for stronger or weaker economic resilience may have a positive impact on their growth in STEM jobs, and those that maybe have had are weaker on some of those health metrics that may impact them. Again, based on what we're seeing currently in real time, it's hard to sort of unpack all that because we're in the middle of it. In hindsight, it'll be clearer, but based on past measures, seems to be something we at least need to be aware of and thinking about. So with that, I'm going to hand it over to Dan, who's going to talk about some specific market areas. Dan.
Thanks, Gregg. So a lot of data between Karl and Gregg, and so what does it all mean in terms of commercial real estate for owners and investors? We think it means you have to follow the people, follow the jobs. That's not necessarily a new idea, but it's maybe more important now than ever before. Individuals, employees, the talent, they have more leverage now, and employers are taking notice. So the areas that are going to be the safest investments are those in which quality of life is high, business environment is friendly, and people can afford to enjoy life knowing they can take care of themselves and their families. These STEMdex markets that Karl just revealed, including the 9 markets where we focus, we feel are exemplary representations of these features. These next few slides here, they're a good representation of what's been happening across the STEMdex top 20 and our markets. I'm not going to read them word for word. You can do that at your leisure, but we'll highlight a few things here. Number one spot, as Karl mentioned, Denver, Colorado. Denver's, greatest strength is maybe their diversified economy. Their major sectors include aerospace, health and wellness, financial services, bioscience, IT software. So again, a good mix of STEM type jobs, but other as well in kind of the health and wellness and the financial services. And, we are owners of commercial real estate. We practice what we preach. We own a building in Denver. Ball Aerospace is a single tenant there. And we actually just bought a new deal recently where Honeybee Robotics is the sole tenant. So again, a testament to that STEM jobs that we track, we follow, and we make sure that our portfolio is comprised of those types of jobs. Next slide, please. Austin, Texas, coming in at 3. That is our headquarters. That is where I am sitting right now. The biggest buzz, I'd say the last year, if you've looked at Wall Street Journal or most headlines, it's Elon Musk and Tesla and everything that has to do with that kind of ecosphere. They've recently announced they're relocating their corporate headquarters to Austin, creating 15,000 jobs. Coming along with it, and they're in the process of building a gigafactory right now for their next Cybertruck. One of the cool things there, Tesla is partnering with local Del Valley ISD to train and hire high school graduates directly out of high school. So that's a little different than maybe what you think of with a STEM job, needing to maybe go to graduate school, some extended version of college, and then you're getting in these. They're partnering with the local community right down the road from their factory. And I think that's going to allow a whole nother section of the economy and, workforce, more blue collar, if you will, access to these STEM type jobs and just, again, getting into that ecosphere. And that'll create, I think, more people that otherwise thought they didn't have access to something like that, maybe can't afford to go to, 6 years of school. Just again, that exposure, I think, is going to be great for the city and other companies that look to mimic this in the future. A couple other ones on here, some names you all recognize. Google, about to take over 1 million square feet in total when their newest building's done. Oracle, like Tesla, announced their headquarters is being relocated to Austin. 2 that don't even make this list, Apple's investing $1 billion in their new campus here, and Facebook is currently looking to add another 1 million square feet of office space. So that just shows you the depth of talent, the depth of strong STEM-related companies that are focused on this region. Next slide, please. So Atlanta, I think the top one here is the biggest one. Earlier this year, Microsoft confirmed it's going to develop their East Coast hub in Atlanta. It's going to create 15,000 jobs. They bought 90 acres in Grove Park, which is one of the poorest areas at the west side of Atlanta. And for context, there's currently 5,000 residents who live in Grove Park. So they're bringing 15,000 jobs to a town that only has 5,000 people. That just shows you the testament, the belief that they have in that market of basically creating their own city and everything that's going to, revitalize on that whole west side of Atlanta that has otherwise been pretty disenfranchised. A couple of the other ones on here, Visa, Airbnb, Cisco's another one that recently announced. They all are happening in Midtown Atlanta, which has been the darling for technology and these STEM jobs. They've all cited the diverse talent pool as a major attraction in this Midtown. Georgia Tech is a huge incubator of that talent, and Atlanta's been the beneficiary of that the last several years. One thing I want to point out here on the Airbnb announcement, I thought it was kind of cool. This was a quote from Airbnb executives when they decided on Atlanta. They were looking for a city with leaders committed to expanding economic empowerment opportunities in a state also seeking to promote economic empowerment for its citizens. They were looking for a city that is open and friendly, sharing our commitment to diversity and inclusion. A city and a state with a robust and diverse technical talent pool. A city that has a robust, creative, and curious culture that attracts a community of creators. And lastly, a city that people want to call their long-term home in a state offering all kinds of natural amenities. So I think those points mimic a lot of what Karl said on other factors outside of just STEM jobs, quality of life, business friendly. It's not just the city they're looking at the state. So it's a collective effort on a couple different fronts that I think you have to be mindful of. It's not just the city, it's the state, because at the end of the day, sometimes, the city's kind of at the mercy of whatever the state doing. So that was obviously a big win for Atlanta and a testament to all those things that Airbnb, among other companies, were looking for. The last market I want to dive into here is Nashville. The biggest one, the announcement was several years ago, but building 1 million square feet takes time. So Amazon announced in 2018 they were building what they call their Operations Center of Excellence. Earlier this year, they just moved into the first half of that space. And subsequent to that, they signed on to build another building, 500,000 square feet, that'll be done in a couple years. The count today, it's at least 5,000 jobs. I think with all the growth Amazon has had and will continue to have, it's the locals think that 5,000 could turn down to 6 or 7 pretty quickly here. So that's obviously been a huge boom for that economy. And then the last one here, Oracle, like Austin, they just closed on 60 acres just on the east side of downtown. They're going to invest $1.2 billion and 8,500 new jobs. That's record setting. That's the biggest announcement that's ever happened in the state of Tennessee. So between Amazon and Oracle and just the machines that those two have, you can just, to the predictive measures of this STEMdex, you should expect to see Nashville climb on that list over the next several years, because these companies are not putting this kind of time, resources, and money behind it to fail. We know that that's not what they're trying to do. The last thing on it that I'll mention on Nashville doesn't make this list, and it's not necessarily STEM related, but is a big factor for us that I know we'll get to in a little bit here. But Alliance Bernstein, global asset manager, they moved their headquarters from Manhattan to Nashville. That's going to bring 1,200 jobs to the city. That announcement happened right before Amazon, so unfortunately that got foreshadowed. But for the real estate community, to have a financial firm of that size move from Manhattan to Nashville is just another testament to these Sunbelt markets, these West and South states that have littered this STEMdex list, but also to Gregg's slides, that just shows you where the homes are being built and the people are moving to. So next slide, please. And this last one, again, not going to hit these one by one. We encourage you to do that at your leisure. As Karl mentioned, a lot of work goes into researching the top metros. So wanted to provide you with some other significant STEM activity happening across the STEMdex markets that we didn't necessarily dive into today. And with that, I will go back to Kelly.
Great. Thank you, Dan, and thank you, Gregg and Karl, for your presentations today. Quickly, before we get into the Q&A, I wanted to answer a couple of questions that have come through the chat. A copy of this presentation will be available on our website right after, shortly after we conclude. So for everyone that's looking for a copy, you'll find it there. So to move into the question, and again, please submit them in the Q&A if you'd like us to address live. We have a question. So what are some of the cities that did not make the top 20 list that you're interested in tracking, either in terms of future STEM job growth or that you believe have some momentum going forward?
Sure. Well, I think, first of all, it's important to reiterate that making it into the top 20 or top 25 of this list is significant, given the amount of metropolitan areas in the United States. And so not making it in that list is less an indictment of a particular city and more celebration of some of the movement of other cities on the list. With that in mind, a few cities that did catch our eye as we were conducting this analysis. One was Miami, ranked 33rd on this year's STEMdex. Now, Miami is actually 48th in terms of location quotient analysis among other metropolitan areas. But over the past few years, it's actually moved up to be within the top 10 in terms of percentage growth in STEM jobs. And so it's an indication that Miami is taking the steps that they need to take in order to attract future STEM growth. And so we would expect, if that continues, that Miami would continue to rise in the STEMdex rankings. In addition to that, Philadelphia and Detroit are two Midwest and Northeast cities that are in the top 5 of absolute and percentage growth. And they made it just outside of the STEM top 20 of the STEMdex this year at 21 and 25 respectively. So because of the strong growth that we're seeing recently in these cities, we would expect both of those to move up as we continue. And then finally, I'll also mention Chicago, ranked 23rd in the STEMdex this year. They've been making some moves in recent years, moving up 6 spots from our last STEMdex, and they were within the top 15 of cities in terms of growth rate of STEM jobs. And so we would expect, if that continues, for them to continue to move up in the rankings.
Great, thank you. That's helpful. I'll maybe direct this next question to both Dan and Gregg. Are there factors outside of STEM job growth and STEM jobs that you focus on when analyzing the potential of a market from a real estate perspective?
Definitely, depending on what kind of real estate we're looking. If it's in residential, we're looking at population and household growth. For commercial development, we're very focused on overall job growth, not just STEM job growth. And there could be areas that are doing very well in other industries besides STEM. I think the STEM job growth in the last year, and Karl can correct me, but I think somewhere around 2/3 of at least the high paying, highest quality employment has fallen into the STEM job industries. And so we look at them as an important driver, but they're not the only driver of what makes a market attractive.
Yeah, I echo a lot of what Gregg said. It's job growth, but again, it's not just STEM. Quality of life, again, affordability. Again, which dovetails into a lot of what Gregg said. Younger folks who may be creators at heart, artists. Especially nowadays, we're in a digital world, right? Content creators, things of that nature that, they just want to be in the next cool place that's affordable and it's got a good quality of life, and, talking about those natural amenities. So we follow a lot of the same stuff, but again, it's not just STEM, because there's a lot of people that are out there that are moving the needle that aren't just STEM jobs. But at the end of the day, it's that quality of life and just where the masses are going in droves.
I think we like the STEM jobs because of the fact, and again, they're not the only thing we focus on, but we notice that, as Karl said, they're higher paying jobs. They're very, high quality jobs. They tend to result in certain kinds of real estate that, people are attracted to, tending to be, higher value real estate as opposed to just real estate in general. And so, again, those are reasons for looking at that.
Definitely makes sense. And Karl, I know you guys have been doing this for 5 years now. What have you learned over the past 5 years of producing this index? How have you tweaked or improved the analysis over the years?
Yeah, the short answer is we've learned a lot in these past 5 years. When we first started this initiative, we conducted a lot of surveys of folks that were involved in the STEM industry and that were tracking this growth. We worked very closely with our friends at CapRidge, and there are many factors that we looked at and thought about as being potential movers in terms of what might affect where STEM jobs choose to locate, which ultimately didn't necessarily pan out to be as impactful as others. And so over the past 5 years, we've been able to conduct more detailed correlation analysis for all of those factors that we shared in our earlier slide that actually move the needle in terms of where are STEM jobs going, and how does that correlate with the cities that show the strongest growth and most potential moving forward.
Yeah, so I saw some of the questions that came up on the chat were, why did this city or that city move so much? And part of it would be, how they're actually doing on some of these different measures. And part of it is the fact that we continue revising the model. And sort of the danger of revising the model is it makes it a little harder to compare year to year what actually happened to a particular city. The danger in not revising the model is that it becomes less accurate. And so we sort of, choose your poison. We chose to continue to refine it based on what's actually happening in terms of job growth. And so, again, hopefully that just makes it that more accurate year after year as we do that. So we think this is the most accurate STEMdex that we've created in 5 years of learning, as Karl said, what moves the needle.
Yeah, great. We had specific questions about climate change, affordability and quality of life. And, as you noted, we are looking at what's actually happened and, what metrics correlate with that. Yeah. Maybe just to move, we have a couple of questions more relating to your first presentation, Gregg, about the housing market. So there's been some cooling in the market. Do you think this is a shorter term or a longer term phenomenon? We see that things have slowed down relative to last year. What do you expect will happen in 2022?
Well, I showed the Fannie Mae forecast, and somebody I saw there was a question on there of what was the forecast showing, and so across the bottom on the x-axis were the quarters. So it was a quarter by quarter analysis, and then on the y-axis was the forecast of single family home sales by quarter. And our expectation is that we got into a little bit of a trough, a combination of the Delta variant whacked us over the summer. We did have a lot of activity that was stimulated by COVID and people deciding they needed to get a different house or a house in a different location that they could commute work from. And so we're sort of, part of it is sort of getting back to normal. Part of it is dealing with the remaining supply chain issues of where builders have been selling the number of houses that they could actually build and close as opposed to the number of houses just to meet demand. And so all of that was a factor. Knock on wood, we think some of those supply chain issues are getting worked out, but they're still with us, but hopefully they're getting worked out by mid-2022. Interest rates are creeping up, but we expect interest rates are not going to dramatically rise. They're still in historically low range. I think watching the housing affordability is critical. Can we continue to deliver product that people can afford? And that will have a bearing on how well we continue to meet the market. But in processing all of that, where we come out is we think we're going to have a strong 2022. We think things are going to gradually, pick up in the fourth quarter and probably strengthen by mid-2022 as we get through some of these supply chain issues. Underlying demand remains strong. The Fed is maybe pulling away some of the support for the economy because the economy is getting better. So that may allow interest rates to creep up a little bit. We'll know more about that in the next month. But we still see the underlying fundamentals looking very good for residential real estate in particular.
Great, thank you. Yeah, will be certainly interesting to see what happens as we end out the year and move into 2022. Since we're running up against time, I just want to again thank Gregg, Karl, and Dan for their presentations today and for participating and joining with us. I'll leave you with the reminder that this webinar was recorded. It's available on our website along with the presentation slides and the results of the 2021 STEMdex. I also recommend that if you've not already done so, that you sign up for our ongoing research publications. And please reach out to anyone who's on this call individually with questions. Thank you, and be sure to tune in again next month.